What can President Trump, the Fed, and Congress do to stay ahead of the curve on the next recession before it happens? Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today we're going to be talking about the economy again. And what the government can do or should do, if anything, to get ahead of the curve on the next recession before it happens. If you buy into the idea of the business cycle, the economy is a lot like a forest that grows, prospers, becomes large, and then with the right conditions, a drought or a lightning strike, there's a great cleansing fire, and then the forest will grow again anew. And so that can be like a recession. So if you believe in a business cycle, there's ups and downs to the economy that tend to dictate that there's going to be a recession once every so often. It's just a part of the economic cycle. And I think a compelling case can be made for that over the course of several years, you can see certain trends that tend to tell you that there's going to be a recession over a period of time. Here we look at things like the 10-year, 2-year spread, and you can see that during the business cycle, the 10-year rate will tend to be much higher than the low short-term rates like the 2-year Treasury. And then as you near the end of the business cycle, that spread narrows and then will go negative for a period of time prior to adjusting, and then usually at about the time of a recession. But what separates some recessions from others? So the American people tend to judge how bad a recession is by how it impacts their pocketbooks, whether or not they lose their jobs. In modern history, since the Great Depression was the worst, when unemployment hit 25%, 1982, and the 2008-2009 Great Recession come after, where unemployment reached 10.8% and 10% respectively, whereas the 1991 recession was shallower by comparison and saw joblessness reach 7.8% at its peak in 1992. The dot-com bust in the early 2000s was even more moderate, with employment peaking at 6.3% in June of 2003. So if you look at the labor market conditions today, what you'll tend to notice is that we're in a very good spot right now with the civilian labor force level is at very high levels, and it's about 163.3 million people in the labor force. Similarly, if you look at unemployment, is at 6 million right now. So as a percentage, we're at 50 years lows on unemployment, 3.7%. We're still growing at 2% in the second quarter of 2019. And so it's economic conditions really don't get much better than that. 3.7 is really, really low. You have to go back to 1969 to see levels that low on unemployment. And wages are rising as well. And you can see that since President Trump came into office, that the wages are accelerating. So you have really low unemployment. You have pretty good growth. In 2018, 2.93% was the fastest economic growth we've seen since 2005 and before the Great Recession and the financial crisis. So I think that the president and the Trump administration, you can make the case that everything that they've been doing with the tax cuts and on deregulation, on getting better trade deals, it's all working. And the economy has definitely seen a little bit of a boost and an acceleration since 2017. But growth has seemed to slow down a little bit. It was at 3% annualized in the first quarter, and then slowed down to 2% in the second quarter. And then you look at the 10-year, 2-year bond yield, and you can see that it has inverted slightly. There may be some push to go to cure the inversion, but right now that's not happening yet. It's still negative. And if it persists for weeks and months, we've seen what happens in the past, where when the 10-year, 2-year tends to invert, if it stays down there for a long while, you can see a recession about 16 months later on average. So that could put a potential recession at about December of 2020 or later or sooner. It's an average. Sometimes the cycle is very quick. Other times it takes longer to develop. And you never know until hindsight which version of that you're in. And so, but it's not a political timetable insofar as what can you do to avoid, say, for example, 10% unemployment. If you're going to have another recession, what can you do ahead of time to see which way this is going and to potentially ease conditions so that you have a soft landing for the economy? If you look at the difference with the current labor force levels at 163.3 million people in the labor force. So at the current labor force levels at 6%, that would mean 4.3 million jobs were lost in a recession. But if unemployment were to go up to close to 11%, that could mean 11.6 million jobs were lost. So you can save 7 million jobs if you happen to get a soft landing in the next recession, which brings us to today. We're not in a recession. The economy's still growing, and things are looking okay. So what can be done to strengthen the economy now so that if and when a recession does hit, eventually we're prepared for as soft a landing as possible? This is usually where politics will intrude and psychology of the economy will take over. People who are pro-President Trump, they're not going to, Republicans, they're not going to want to talk about a potential recession, particularly ahead of the election, because it's bad for business and they don't want to be accused of talking down the economy. They look at the data that'll suggest that incumbent parties don't do as well in recessionary environments. And so you don't want to see a recession, so you don't want to talk about it. So you have a mixture of denial on one hand and then alarmism on the other. Democrats are going to want to play up the possibility of a recession ahead of the election because they think that'll help them politically. It's very, but when you have a mixture of denial and alarmism, you're not going to really be talking about things that can improve the economy, probably. You're going to be talking about asserting blame or and making political arguments, not necessarily policy oriented arguments. But if you're pro-Trump, you probably want to get ahead of the curve on this, because if you look at 2008 and 2007, when the Bush administration was caught flat-footed to address the imminent recession, they got the 10-year, 2-year signal on bond markets in 2006 and in 2007. So they could have gotten ahead of the curve. But they didn't. They were caught flat-footed, and then in 2008, they're nationalizing the government-sponsored enterprises, Fannie Mae and Freddie Mac. They're doing TARP. They're bailing out banks. And then Republicans got wiped out in the election. Democrats wound up with a filibuster-proof majority in the Senate. They won the House, and they won the White House, and they were able to run the table on their agenda for the next 2 years. So there's definitely arguments to be made for getting ahead of the curve here. This is one of the reasons we're supposed to have a apolitical central bank, but you can make arguments that the Federal Reserve acts politically too. They kept the 0% interest rates pretty much throughout the entirety of the Obama administration. They only began hiking just a little bit at the end of 2015, and then they didn't fully start hiking until after the election in 2016. So arguably, they left the rates too low for too long, and then they started hiking it into the teeth of what could be seen as inversions that are occurring right now. So the effective federal funds rate, it got hiked upwards, and now they're starting to come down again in July, a quarter of a point. It's at 2.4% right now as of July, and then it's going to be coming down. So it's about a range between 2 and 2.25% based upon the Fed's most recent meeting, where they cut the interest rate on July 31. Now, where does that put us in the business cycle? Well, the Federal Reserve versus the 10-year Treasury has been inverted since May, and the Fed has not acted to ease conditions to cure the inversion. In previous runs on the cycle, for example, in 1998, the 10-year inverted with the federal funds rate. The Fed intervened. They cut the interest rate, the federal funds rate, the policy rate that it sets. And then it seemed to work. Everyone didn't panic, and then the economy prospered for the next couple of years. And it wasn't, you didn't get a recession right at that time. So the Fed, there are examples where the Fed can cure its rate, its inversion, but right now we're not seeing that yet. And you could argue, why aren't they doing that? Are they acting politically? There's certainly a Fed governor that said so. Former New York Fed President Bill Dudley said that Trump's re-election arguably presents a threat to the economy. And so Fed officials should consider how their decisions will affect the political outcome of 2020. So the Fed should, I guess, say that they're going to help the economy to tank just so they can get rid of Trump. I don't think that's a good policy, but we can argue about this. The Fed has meetings coming up in October and also in September. So very soon they're going to be meeting again, and we'll see how big of a cut they do. I would argue they need to do at least a 0.5 percentage point cut on the federal funds rate. And President Trump has argued for a full percentage point to go down. And he's been arguing since last October that the federal funds rate was too high and that the Fed needed to start easing immediately. This might be the thing that could have the biggest impact on the economy right now in terms of what the Fed's going to do. If they leave the rate too high and they leave the inversion there on the 10-year federal funds rate, I think that you're going to see markets not react kindly to that, and it could. Some are arguing that the Fed could cause a recession unless it cuts significantly interest rates. This is a report from CNBC. Quote, the next recession in the U.S. could be triggered by a still restrictive Federal Reserve policy unless the central bank makes a committed and sustained effort to lower interest rates, Stifel's Barry Bannister says. Rates signal a bear market, and Fed hesitations risk a repeat of Custer's last stand at Little Bighorn, Bannister wrote, referring to the 1876 battle between U.S. forces led by General George Custer and several Native American tribes. Quote, the Fed should quickly go below neutral since crises occur at progressively lower spreads to neutral. So there are people who are arguing that the Fed is too tight right now. I tend to agree. I think that the Fed has been way too tight, and you can see it based upon the U.S. dollar is way too strong. You're at historically high levels on the U.S. dollar. This is the trade-weighted U.S. dollar index, and you can see it's near historic highs here. Close to where it was in right prior to the 2000 recession. And so with such high demand for U.S. treasuries and dollar-denominated assets, this leads to a strong dollar. There's a flight to safety going on right now as we near the end of the business cycle, and that's not going to help economic conditions to continue the boom going. Now, it might be time for the boom to end either way, but no, these are just the factors that are in play right now. The Fed could cut rates, and that would certainly help to ease concerns about the economy right now. But if they only go down 0.25% at the next meeting like they did in July, that's probably not enough. And markets are expecting more cuts to beginning in September. Just to cure the inversion, you need to go down by 0.65 based on the latest reading. And to cut down a full percentage point, it might safely cure the inversion and restore confidence that the Fed is not asleep at the wheel. We talked about 1998, the next meetings with the Fed. As for President Trump, moving beyond monetary policy, he remains committed to getting better trade deals and is using tariffs and sanctions to force China to the table to deal with currency manipulation. Treasuries designated China as a currency manipulator for the first time since 1992 through 1994. And President Trump is certainly considering more active measures. He might consider accelerating his timeline for escalation to include the use of broader economic sanctions. I think that could send a strong message to Beijing, and that they're going to have to make a deal. They have to force a resolution sooner rather than later. And if Trump's re-election is in question, that compresses the timetable for Trump to act. If he wants to get anything done right now, he can't bet on being there in 2021. There's no guarantees with global economic conditions softening. China appears to be betting that it can wait Trump out. So that compresses the timeline as well. But that's Beijing's choice, not Trump's. And they had a deal in May, and Chinese President Xi Jinping, he balked. They reneged on the deal. It was going to address everything from currency to intellectual property theft. forced technology transfers, and U.S. access to Chinese markets. If they don't want a deal, it might be best for Trump to rip off the Band-Aid as soon as possible and begin looking at alternatives elsewhere. We've seen Trump do a deal with Japan on U.S. agriculture. Now there's another deal with Brazil on U.S. agriculture. They're going to buy more ethanol, more corn in both Japan and Brazil. And that's going to ease, I think, market concerns, especially from U.S. ag states that are concerned about the trade posture ahead of the 2020 election. Trump's getting better trade deals. He's saying we don't have to do it with China. We can do it elsewhere. In the meantime, Congress has the U.S., Mexico, Canada agreement on the table, and it's time to act to shore up these alternatives to China. There's nothing that you produce in China that can't be produced elsewhere, whether here, in Mexico, in Japan, in Brazil, etc. Here's a statement from ALG President Rick Mann. He emphasized the importance of the trade deal. Quote, as the decoupling with China begins, President Trump is ahead of the curve in securing trade deals with Japan and also Canada and Mexico as supply chains are moving away from China. There's nothing that China produces that cannot be produced elsewhere. The USMCA is about to be submitted to Congress and is ready to be adopted. It will be a boon for U.S. exporters, including agriculture, and addresses labor conditions in Mexico. Plus, the currency provisions against competitive devaluation will set a gold standard in terms of shaping future trade deals. It is important that Congress act now and not get caught flat-footed. After 25 years of complaining about NAFTA, it's finally time to do something about it by supporting the new USMCA agreement. For its part, it might consider the Trump administration a payroll tax cut to boost in consumer spending and to help households pay down some debt. That's something else they can consider. There's also talk of indexing capital gains taxes to inflation. One thing Congress and the president seem to share in common is a desire to do something about infrastructure. And if you're a congressional Republican, maybe you'd rather do a deal right now. You don't want to wait until 2021. If Democrats are going to win, they might have all three branches of government again. And their infrastructure bill is not going to include private financing as much as what President Trump is offering right now. Then there's other trouble spots. The dollar is too strong vis-a-vis other currencies, and leading to tepid growth and almost no inflation. And even if it temporarily weakens in the downturn, the relative strength of the dollar versus trade partners will not help to foster a U.S. recovery. So Trump should be looking to come to some sort of U.S. monetary accord that can address the strength of the dollar vis-a-vis trade partners. And I think that we could be stronger for that. Then there's U.S. corporate debt. This is something a bit of a trouble spot. Here's a report from Jesse Columba, realinvestmentadvice.com. OECD published a paper called Corporate Bond Markets in a Time of Unconventional Monetary Policy, which showed that outstanding global corporate debt has surged over the past decade in both emerging economies and advanced economies alike. Total outstanding corporate debt increased by 70% from $6 trillion in 2008 to $10.17 trillion in advanced economies, including the United States. And that's a huge number. It's close to $10 trillion in the U.S. alone. Total outstanding corporate U.S. debt. And so you could see a big popping of this bubble here in the next recession. There better not be any bailouts. I don't think that would help to save the economy anyways from a recession. You want to get ahead of the curve on the economy, but doing bailouts is very much looking in the rear view mirror. It didn't help in 2008. It certainly didn't prevent the recession. And then the TARP bill that they ended up passing ended up being inconsequential. The Fed was just going to come in and do quantitative easing and buy trillions of dollars of mortgage-backed securities from the banks and investment houses that didn't want them anymore. So bailouts are not going to help. And also, after Dodd-Frank, they did the Resolution Authority, the Orderly Liquidation Fund. I'm willing to take it on faith that that's supposed to avert the need for bailouts because Congress promised after Dodd-Frank that there would be no more bailouts. So I don't think we should be giving one ahead of time, and certainly not on that thing, not on corporate debt. Now, as for pensions, multi-employer pensions, I think this is something that could have been addressed before the last election in the 2018 by the Republican Congress, but they didn't do it. Multi-employer pensions are very much underfunded right now, and that could be a problem in the next recession. There's bills in front of Congress, last Congress, and also this Congress to address the multi-employer pension difficulties. And I think that the price tag is likely to go up after a recession. So maybe Congress can work together, prove that big things can get done right now with President Trump. You have a Democrat House, a Republican Senate. Maybe you could do something on that before the recession. Don't wait till afterwards. It's going to get more expensive. Elsewhere in housing, the Trump administration might consider doing something bold. I've proposed a free market way Trump can rebuild America's cities and privatize public housing. In the Soviet Union, when it was collapsing, Eastern European countries did an experiment in private housing. They took all the public housing stock and they transferred title to the tenants who lived there. Well, maybe we could try the same thing in America. You have 1.1 million households that are in public housing nationwide. What if you turn deed over to them and end the federal housing projects, and then people could either sell the units they live in, they could be refurbished, they could rent them out, and they could be an income generator, and you could see inner cities flourish. Whereas right now they haven't been doing so great. Unemployment's eased, I think, during the Trump administration, but that's an extremely volatile indicator. The next recession that goes down, you're going to see unemployment in the cities rise again, particularly amongst African Americans. I don't think that that's long term. It's really sustainable unless you're going to really foster conditions for growth in the inner cities. And I think ending public housing and increasing private property ownership in the cities could help do that. Most certainly. And there's a model with Eastern Europe that Trump could follow and get advice from other countries that have done this before. And you can kind of see what the predictable outcomes are. You create a private market for housing overnight, and this can be very, very beneficial. And so that to mitigate potential foreclosures now in the next recession, the Trump administration, Fannie, Freddie, the FHA could consider doing a certain amount of principal forgiveness on if mortgage principal is deemed to be too high. You could cut monthly payments that way. You could do low interest rate refinancing. Interest rates are really low right now. It's probably a good time to do mortgage refinancing if you're thinking about it. Also, the housing stock that's owned by Fannie, Freddie, and the FHA could be turned over to municipalities. These are foreclosures, and then they could be used to serve as housing for the working poor or those who are at risk of becoming homeless. We're seeing a homelessness crisis right now, and there's plenty of housing. It's just not being made available. So maybe Fannie, Freddie, and the FHA could turn over some of the housing to municipalities, and they could address that. We've talked about the strong dollar. Trump could work with U.S. allies on a monetary accord, and it's one of the key reasons interest rates keep going lower and lower, and you could have negative interest rates is there's such high demand for bonds, particularly U.S. Treasuries. You're seeing high demand for Japanese debt and German debt to offset deflationary conditions. So you might see negative interest rates in the next recession, and that's not going to help anybody. We don't want to see negative interest rates, and I don't think it's going to be beneficial if we get them. Just as high interest rates signal too much inflation, low or negative rates signal the dreaded deflation that wreaked havoc in the Great Depression and recession. Just ask Japan and Germany how negative rates are helping to boost economic growth there. And then there's always the option of doing nothing, which is not unfounded. Oftentimes, the federal government will end up doing the wrong things at the wrong times and usually too late to make much of a difference ahead of a recession. I don't think it's too late yet, though. Particularly, the Fed should be lowering interest rates at the federal funds rate level and curing its inversion that it's causing right now since May. That could certainly signal the onset of a recession. I think you could buy time like they did in 1998. Maybe not, but I still think rates are too high either way. And I'll leave you with the close here. Like good forest management, clearing out the underbrush, much can be done ahead of time to lessen the negative impacts of the next recession. The less bad it is, the less revenues will take a hit, and the less bad the budget deficit will be. Revenues tend to go down during recession. So if you want to offset a potential recession, you could do it ahead of time, and then maybe unemployment won't go up so high, and then revenues won't take as much of a hit, and you won't see such bad budget deficits and more debt, which is not good for the economy. We're already at 100% debt to GDP. If you look at Japan, they're at 200% debt to GDP, and I think it's a weight on future growth. And when you see low interest rates, it's forecasting lower growth. Hopefully, we won't have another recession, but it's always best to plan ahead, even with the presidential election year around the corner, rather than the typical pattern of denial and alarmism with the flashing red lights on from the bond market. The American people would appreciate that their leaders, including President Trump and Congress, get ahead of the curve for a change and show us how it's done just this once. That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.